So good morning, everyone. So I have here our next topic is financial statement analysis, specifically financial ratios. So we'll begin with the liquidity ratios. Okay, so when we say liquidity ratios, we have the different types of liquidity ratios. One example here is current ratio and the quick ratio. So when we say current ratio, the current ratio is also known as the working capital ratio. It is a way to assess the overall liquidity of the company by comparing the current assets to current liabilities. In here, we are just comparing our assets as to its current liabilities. It's because we will be able to know if our company is or has the capacity to pay our short-term liabilities or currently maturing obligations. Okay, so it's more preferably that it is good that we have more current assets than our current liabilities. Kasi if mas marami yung liabilities, it's not good to the company and we don't have the capacity to cover all of those because short po masyado yung assets natin. So most likely, mas maganda or it is advisable or it's a good analysis if all of its assets are higher than its liabilities. Okay, here in quick ratio, the quick ratio is also known as the acid test ratio. Unlike the current ratio, the quick ratio is more conservative. Okay, why does it describe as conservative? It is in the sense that it does not include all the current assets of the business. Okay, it considers only those assets that can be rapidly converted into cash. The cash marketable securities, the receivables. It takes away inventory because the firm may not be easily be able to convert it into cash. It also takes away prepayments because they are not converted into cash but are intended for operations use. So the quick ratio may be computed as current assets less inventory less prepaid utilities. So same pa din ito sa current ratio. It's just that it only consider quick assets or current assets. Hindi kasi quick assets si inventory tsaka prepaid utilities. It's because we have inventories that are slow-moving inventory. Okay? So they are not easily convertible into cash. Same with the prepaid utilities. So kapag may mga preparals tayo, they are not liquid, okay? As compared to cash, marketable securities and accounts receivable. So accounts receivable, sir, why is it included in the quick assets section? It's because accounts receivable can be refinanced. Okay, so in higher accounting, you will know that assets can be refinanced, it can be sold to a bank, okay, for financing purposes. Ayan, so that is why accounts receivable is served or considered as liquid or easily convertible into cash. Ayan. So those are the liquidity ratios. Okay, remember the formulas. Leverage ratios muna tayo. So when we say leverage ratios, so if the liquidity ratios talks about our capacity as a business to pay currently maturing obligation. Here in leverage, kabaliktaran, it measures our capacity to pay long-term maturing obligations. So we have debt ratio. The debt ratio measures the percentage of assets funded by the creditors. It is computed as total liabilities over total assets. Here, hindi na siya current, kundi lahat na ng liabilities involved. We are going to measure if ilang percentage ba yung total liabilities natin sa total assets. In here, we could say or we could analyze that if our liabilities is lower than our assets, we can say that our company has the capacity to pay our liabilities. Kasi dapat talaga mas higher pa si total assets over our total liabilities. Now here, equity ratio. So the equity ratio indicates the percentage of assets funded by the owners. So it is the amount left over from the debt and can be computed by subtracting debt ratio from 100%. So another method, if you will be confused by this formula, we have this. We can also use this. Equity ratio is equal to total equity over total asset. assets. Ayan. And the last example for the time for the leverage ratio is your times interest earned ratio. So this is also known as the interest covered ratio. It measures the extent to which a company's operation cover interest expense. It evaluates the ability of the company to pay the interest on its debt. So this ratio shows how many times the company could pay the interest with their before tax income. Okay, so it indicates also that whether a company can afford to pay interest by comparing the operating income and interest expense as follows. So here the times interest earned ratio will measure if we have the capacity to pay our interest expenses. Interest expenses came from our long-term liabilities such as loans, okay, yung bonds, yan, yung mga long-term maturing obligations natin. Okay, so kasi there are times na malaki yung interest expense, uh, it's not or it cannot be covered usually by operating income. Okay, usually or the rare cases or most cases. Okay, so ayan. So the here, ang most suggested dito is dapat mas malaki yung operating income kaysa sa interest expense. Okay? And the last ratio is profitability ratio before we could move into our practice later. Okay? After this. So the types of profitability ratio is the gross profit margin. So this is a financial metric used to assess a company's financial health and business model by revealing the proportion of money left over from revenues after the cost of goods sold. Okay, so we are just measuring okay, ilang percentage ba yung naiwan? Okay, from our profit after deducting sales over its cost of sales. Okay, so ayan. So, gross profit over net sales. Next is operating margin. So in operating margin, this is a profitability ratio again that demonstrates how much revenues are left over after all the variable or operating costs have been paid. So this ratio is important because it helps show how strong and profitable a company's operations are. So it is computed through this formula, operating profit over net sales. So you have it, you heard it right. So we are measuring the profit percentage over our net sales. Okay, so ang most suggested dito is dapat mas malaki si operating profit for us to, we could say that we are really earning and we really utilize, okay? Ayan. So, ayan. Next is, or the last one is net profit margin or return on sales. So this ratio measures the overall profitability of the company. Kasi yung kanina operating profit pa lang yun without uh, without fully deducting the expenses. Okay, it evaluates the amount of net income earned which each peso of sales generated. It is the ratio that shows the percentage or what percentage of sales are left over after all expenses are paid by the business. So it uses the formula net income over net sales. So i-measure niya lang kung ilang percentage na lang ba yung naiwan from the income after deducting all of your expenses. Okay, so ayan, net sales natin. So we have an example here. Okay, so let's have this one muna as liquidity and leverage ratios. Okay, ayan. So we have to solve first liquidity ratio. Okay. Ayan, so the current ratio first. We have here a figure as an our example. So current assets, meron naman tayo total current assets dyan. It's 1,202,000. Then next is the current liabilities. Saan yung current liabilities natin? 186,000. Okay, so divide it by, okay, the current assets over the current liability. Divide lang natin. Okay, so the answer is 6.46 or 646%. So here we could really say that our current assets is really higher than our current liability. Therefore, we have the capacity to pay our liabilities kasi 600 times more or higher si our assets natin compared to our current liabilities. Now, let's proceed to our quick ratio. The current assets natin, same pa din, 1,202,000. Okay? But here, we have to deduct inventory and prepayments. Now, may inventory ba tayo dito? Wala naman. So, okay, we'll keep it blank or zero. Then, prepayments. Magkano ba lahat ng prepaids natin? We have the supplies, 270,000. Plus, the prepaid insurance, 5,000. Plus, our prepaid rent, 250,000. Enter. So that's 525. Check natin. 270 plus 5 plus 250. Okay. So our quick asset is 1,200,000 less 525,000. So our quick assets is 677. Then our current liability is same pa din, 186,000. Okay, so therefore our quick ratio, divide lang natin. 667 divided by 186. Okay, that's 3.64. So, maganda pa din yung figures na yan kasi it tells us that mas marami pa din yung quick assets natin over their current liability. Therefore, we have the capacity to pay our currently maturing obligation kasi it's 300 plus higher. Okay, our assets is 300% higher than our current liability. Now, let's proceed to our solvency ratio. Okay, so for the solvency ratio, we have debt to assets ratio, equity ratio, and times interest earned. Now, for the debt to assets ratio, we need our total liabilities over the total assets. So, our total liabilities here is 386,000. Then, ulitin natin. 386,000. Then our total assets is 2,048,000. Therefore, okay, we will measure if ilang percentage pa yung liabilities natin over our total assets. Divide natin over the 2 million plus. Okay, there you have it. It's 0.19 or 19% will be our liabilities over our total assets. So, here magandang figure to kasi medyo maliit lang yung utang natin at marami-rami yung assets natin. So it's good. We have really the capacity to pay all of our liabilities if gano'n. Okay, here, total equity and total assets. So we are going to measure now the total equity percentage is measured by our total assets. So our total equity here is 1,662,000. And our total assets is 2,048,000. Okay, so we'll measure it. 1,662 divided by 2,048,000. Therefore, it's 81%. So our capital is 81% of our total assets. So that's a good number also. So 81% siya. And for the last solvency ratio, it's the times interest earned ratio. We need our operating income here. So our operating income is, okay, allow me to unfreeze it muna. Okay, our operating income can be found not on the balance sheet but on the income statement. So hanapin natin si operating income. Operating income can be done or we can get operating income after deducting the gross profit over your operating expenses. So here, our operating income is 152,400. Lagay natin dito, 152,400 divided by our interest expense. Our interest expense here is 28,800. So, 28,800. Therefore, operating income divided by our interest expense, here you have it, it's 5.29%. 29. So it's 500 500 higher percentage higher than your interest expense. So your income is 500% higher. Therefore, we have the capacity to pay our interest expense if that would be the case. So that's the solvency ratios. And now, we'll proceed to the profitability ratio by having or letting this example be our basis. Okay? So next is the profitability ratio. Okay, so for our profitability ratio, okay, wait. Okay, medyo nawala. Ito na. Finraise ko kasi siya. Ayun. Okay. I think it's more ano na. Okay. Para mas ano siya, mas malaki siya. Okay, for our gross profit ratio, we need our gross profit divided by our net sales. We are just measuring it if ilang percentage ba yung gross profit natin sa net sales. So our gross profit here is 444,000 and our net sales here is 1,080,000. Okay, so our gross profit ratio here is 444 divided by the net sales. Okay, may problema. Wait lang. Ito. Yan. So, I think this is due to rounding off. Okay, wait lang ha. Huwag nating i-round off. Okay. 444 divided by... Okay, ayan. So, dalawang decimal place lang. Ano yan? Okay. It's 41%. Ayan. Therefore, our gross profit is 41% of our net sales. Yan. So, medyo malaki din. Pero kapag itong 41%, ileless pa natin yung mga expenses natin, parang yung net income natin is mababa na talaga. Okay? So, next, gross profit. So, therefore, kapag ganito lang gross profit ratio mo, it's 40% or 41%, we need to minimize our expenses para malaki pa din yung profit natin. Okay, gross profit na tayo, ratio. Operating profit margin pala. Forgot. Okay, change lang natin to. Operating profit margin. Okay, for the gross profit, operating profit, okay, our operating profit is, or income is 152,400. Okay, so our net sales is 1,080,000. Okay, therefore our operating profit margin 152 divided by your net sales is 14%. Okay, liit-liit na, no? So our operating profit kasi, from the gross profit, we are going to deduct our operating expenses. But it's not that, hindi pa lang dyan, meron pa tayong expenses na hindi na-deduct. For example, the income and the interest expense or the income tax. So, sobrang mababa talaga. Okay, we could say na hindi na-manage masyado ng business na to yung mga expenses nila. Okay, and the last is net profit margin. Net income over net sales. Okay. Net income. Ayun. Our net income is 80,340 and our net sales is 1,080,000. So we could say here na ang over the 1,080,000 lang ang ano natin, ang nakuha nating income. So divide natin, so that's somewhat 7%. Meaning, sa income natin, sa sales natin na 1,080,000, 70% of that will be our net income. So it's really, so the challenge here is the company must be wise in utilizing their resources or spending their expenses. So okay, i-minimize nila. So that's how you analyze financial ratios. There you have it. So I hope that you understand the meaning or the message of this ratios. It's not just a ratios, it has something to do with analysis and what the company should uh, provide, okay, as a rules to manage your resources. Okay, so that's the end of our video tutorial, and see you next meeting for our next tutorial.